If you walk into your bank to be pre-approved, there's a 1 in 20 chance that that mortgage is actually the best mortgage for you. I first learned this when I was in university. I ran a small property management company, and two different investors had two pretty different outcomes. They both earned similar income, but one had their bank tell them that they were maxed out after buying one rental property. The other bought 8 rental properties in the 5 years that I worked with them. And when the one approached the other, how they were able to purchase so many properties, all they said is, I work with a mortgage broker. And for me, I thought the lesson was simple. The answer was just working with a mortgage broker helped you qualify for more. But that was not the case. This actually started my journey. I took a job at a mortgage company that worked exclusively with mortgage brokers so that I could learn more. And what I found out is that mortgage brokers just don't magically help you qualify for more. The real difference is that every lender looks at your income differently. A broker's job is to compare these different rules and place your mortgage in the one that makes most sense for you. And I had a client whose purchase shows how enormous this difference can actually be. A client of mine, we'll call him John. I didn't get permission to use his name. And John was looking to keep his home as a rental and purchase a new property. He walked into his bank, CIBC, and they had approved him for $630,000. And John wasn't super happy with that number, so he came to me for a second opinion. When I reran the numbers, I saw that CIBC had just run the most basic rental calculation for him. Using Scotiabank's option, he was able to qualify for $830,000, a $200,000 difference. Working with lenders like RBC, BMO, or Manulife, he was able to qualify for $950,000. Now, I want to be careful here because the lesson is not that CIBC is a bad lender. CIBC actually has some programs that would allow for John to have qualified for more. So either the person who was at CIBC didn't know about these programs or didn't think that John was a good fit. And just because Scotiabank in this instance didn't qualify for him as much as Manulife or RBC or BMO would, it doesn't mean that they're a bad lender to work with. Scotiabank's program actually attracts a lot of condo rentals. Because of how they use the income and the debts, it actually is really helpful for those type of properties. They are also great to work with when it comes to purchasing a rental itself. The big thing is that mortgage brokers are matchmakers. They're trying to figure out who is the best situation to be in. So what framework do I use to determine what lender you should work with? The first thing that I'm doing is I'm looking at your budget, whether that's a monthly payment or a total purchase price. This impacts what I do a lot. The next thing that I'm looking at is your qualification. There can be a ton of work running through each type of scenario. Now look, running through 20 different scenarios are extremely complicated. So over time, I have lumped about 6 or 7 different groups that have similar qualifications. It's not a perfect scenario, but at least gets me in the ballpark of qualifications for each of the lenders. Once I can compare what you're looking to purchase for to what you qualify for, that gives me a pool of lenders to start looking at your interest rate. And in John's example, he was only looking to purchase at $800,000. So since Scotiabank currently has the best interest rate in the market for John's specific type of mortgage, that's where we could go. Even though it wasn't the best qualification, it doesn't matter that RBC or BMO or Manulife can qualify him for more. If he's only looking for $800,000, we want to compare interest rates to all of the lenders that he qualifies for. We factor things in like how much of my commission can I use to lower the interest rate? Is there special programs? Or since I do a certain amount of volume, are there discounts that I can get beyond what they're advertising as the rate? So after these conversations, the next thing that I'm doing is comparing the rates themselves. And most people would think it's just as simple as choosing the lowest interest rate. And in this case, it was. Scotiabank was far and away the best interest rate for John. But sometimes when it's close, there's other factors that we want to look into. Things like, hey, I'm getting an inheritance and I might want to put money down. Or, I've got kids going into university and I might need to refinance. Or I'm looking to sell in 2 or 3 years. Those things can play a pivotal role in what interest rate is recommended. Not just the length of term, but actually the lender themselves. So for instance, if there's a chance that you might be selling in 3 to 5 years, going with one of the big 5 banks, even though the rate is 0.05% lower than someone else may actually not be your best interest. We see it all the time. Every time rates start to go down, we see these news articles. Hey, TD charged this client a $30,000 penalty. Oh, Scotiabank ended up charging $20,000. RBC charged $18,000. All of these are stories that come out because the way that banks calculate penalties are different. And the more likely you are to break the mortgage, the more we have to factor those in to the conversation on rate. Look, I also don't want to say that every deal is this complicated. Okay? If you're a first-time home buyer who's got less than 20% down, you work a salary job, the options or the way that lenders treat your pre-approval are all going to be very similar. That's where these rates and these other circumstances take a more important role. At the same time, if you're self-employed, you own a rental property, you have child tax benefit, you have to pay spousal or child support or a consumer proposal, bankruptcy, the more things that we add to the complexity of your deal, the more the chances of one lender being a better option than the other, the higher the chance that one lender could be a substantially better option than the rest. And look, you don't need to go through a mortgage broker. This isn't a sales tactic to make mortgage brokers look better than banks. What I'd recommend, if you don't want to work with a broker, is send your deal into, the 10 to 15 different lenders who work with clients directly and see what qualification difference that you get. Also take note of how complicated the deal is that you're putting in front of the bank. The more complex the deal, the more likely you're going to see large swings in interest rates and large swings in pre-approval. So this is what I want to leave. As a first-time home buyer who's salaried, who's got less than 20% down, your options in terms of qualification are more limited. So looking at rate and looking at these other factors are more important than if you have other complications. At the same time, if you own a home, are putting 20% down, are self-employed, these factors can make a huge difference in what you qualify for. The role of a mortgage broker is more matchmaking than it is hardcore negotiation, although we work as hard as we can to get you the best interest rate. And if you dislike mortgage brokers, for whatever reason, the takeaway that I want you to have, it's not one bank's rules are all banks' rules. Apply to as many different places as you can. Get an idea of what your qualifications are, and then make a decision based on your budget. People who work with their bank will often say that my bank is the best. And my answer to that is the same every time. The best for who? There is no one bank that is the best in all scenarios. And even for your own property, the bank you used when you bought may not be the best bank for you at your renewal. It may not be the best bank for you when you've got 5 years left of your mortgage. So make sure you shop. Make sure that you get the best mortgage for yourself. And if you like this content, subscribe, and we'll do it again next week.